Hey traders, this is Blake Morrow with Trader Summit, and with me today it is Friday, and of course I've got Jim Welsh of Macro Tides. Let's bring Jim on over. Jim, how are you? And happy Friday to you.
I'm good. Happy Friday. More importantly, happy St. Patrick's Day, which obviously is on Sunday, and that's the one day everybody, whether they like it or not. Uh,
Yes. It is going to be St. Patty's Day, so I got to remember to wear green.
you better.
Unless you want to get pinched in the
The
butt a lot.
leprechauns may pay a visit that you may not enjoy.
All right. Well, Jim, this is the week that was. Obviously, we had a lot of data come out this week. How did you interpret everything that came out? And I know the first chart you brought has to
Right.
do with CPI, but everything that we saw, where you at?
Yeah. Well, in Monday's weekly technical review, I went through the CPI and explained why I thought it was going to not be a good report. With energy prices up, prior to the last 12 months, energy prices have been a subtraction, and they were a subtraction in January, even though energy prices were up. So I thought there'd be some catch up. And then the PPI, I thought, would also deliver some bad news because we're starting to see goods prices rebound. And so net, I thought that those reports would engender Treasury yields to rise. The dollar would get a bounce. We'd see a pullback in gold. And I thought the equity market wouldn't like it either. But what we've seen consistently in recent weeks, if there's any news that the market doesn't really like, it just simply ignores it, in part because the focus is so much on AI, semiconductor stocks, and just the pure momentum that the market has exhibited. So, in my view, I expected a rational response to bad inflation news. We got it in the dollar, gold, and bonds. We did not get it in the equity market. And to me, that just adds to more and more evidence that we're seeing kind of manic behavior, which is not healthy at some point in time. So I think the market is going to get even more negative news next week when the Fed announces the dot plot, the summary of economic projections, and I think Powell's post meeting press conference is good. I don't know how he doesn't have, I don't want to say a hawkish edge, but it's certainly not going to have a dovish bent.
All right. Well, if it's not going to have a dovish bent, then what do we have to look forward to? I mean, stocks are sitting here trading at all-time highs, basically. I know we've come off a little bit on a Friday, but still, overall structure of the market seems pretty bullish. I mean, do you think that that's going to change much? Well, I guess we should probably just get into your charts so you can actually answer that.
Yes.
We don't
want to take the thunder before the lightning shows
Yeah.
up.
I was actually gonna do that for you, but keep in mind that I got other things for you to do. So let's take a look at your charts here, and let's start with your first one that you brought is CPI.
Yeah. So, what we saw last year was tremendous progress. The red line is the headline CPI, and you can see it was up to 9% in June of 2022. And by June of 2023 was down to, effectively 3%. Well, since June, so we're talking 8 months, it's flatlined. The core has worked its way down, in part because shelter, used cars, a few other things have been coming down. But you can see, obviously, the downward slope is starting to flatten out.
Yeah.
And so, in a sense that this is not the Fed's primary inflation tool, it's the PCE, but what gets more attention in terms of consumers and media and all the rest, it's the CPI. And so to me, this flatlining of progress, I think the Fed is going to look at that as a cautionary tale of there should be no rush in terms of cutting rates anytime soon, given the stickiness. And the PCE, which comes out, I think, on March 29th, it's always the last few days of the year, is also going to show some stickiness as well, Blake, because some of the components of CPI and more so the PPI feed into the PCE. And it's going to be, I think, a gain of 0.3. Well, you annualize that, that's 3.6. The year-over-year numbers will probably be hanging around 2.8. So again, from the inflation news standpoint, some of that has begun to stale from the Fed's perspective after tremendous progress. And it just says that they're facing a situation where, all right, the economy continues to grow faster than expected, and inflation is becoming more stubborn. Now, here's the thing. I can't imagine that the Fed doesn't look forward. If you look in March of 23, the headline inflation, 0.08, that's the takeaway value. So we're going to take off 8 basis points. And if we add 40 basis points, the headline CPI could jump from 315 to 347. If it's only up 30 basis points, you're still talking about 335. So in other words, we're talking about this headline CPI for March, which will come out right before mid-April, being at 3.4, maybe 3.5.
Yeah.
So now instead of any progress, we're seeing the exact opposite. And it isn't just 1 month, it'll be 3 months where it's trending higher. The core will remain pretty steady. It's 32 basis points coming off. If you add 30 basis points, it's a push. It'll be a rounding. It might dip to 3.7. It could tick up to 3.8. But my point is, this will just reinforce the narrative that, whoa, wait a second. Inflation isn't continuing to move towards the Fed's target. And, I just think that the markets are going to have to deal with that because they've, as we know, coming into this year, they were pricing 6 to 7 rate cuts. Now it's about 3.5. And I think that might be altered based on this is the dot plot. So you got 20 people on the Fed saying, this is where I think the Fed's rate should be at the end of 2024. So, it's hard to read the dots, so I try to summarize it. So you had 14 of the 20 people were like, okay, at most 3 cuts or less. And of that 14, 6 were at 3. All right. So the question is, were they leaning toward more than 3 or were they stretching to get to 3?
Right.
And given the data points that we've seen, I think there's a good chance that 1 or 2 of them will scale back from 3 cuts to 2. The other thing, you have that 1 dot down to 387, and that's going to disappear. I think that was Goolsby. And just review. Remember after the December meeting, everybody said, oh man, huge pivot. What the heck is Powell doing? And I explained that Powell gives his opening statement. He doesn't write it the morning of the meeting. He writes it probably the day or 2 before. And in his opening statement, everything, Blake, was exactly what he'd been saying in prior months. But what happened, I believe, is you had the CPI on Tuesday of that week. They met Tuesday, Wednesday. The PPI came out on Wednesday morning, and Powell explained, hey, we encourage people to change their dots, and they can do it as late as they want, like mid-morning on Wednesday, before they put it and release all this information. And my conjecture at the time that people were influenced by 2 soft readings back in December, especially the PPI came in pretty weak. And I think some people, I think it's Goolsby, oh yeah, man, let's go with a bunch of cuts, right? And so I just think that the odds are the dots aren't going to be anywhere near as friendly as they were in December. I think there's the potential the median will not show 3 cuts, might only show 2.5, maybe only 2. And this is what I'm talking about, the Summary of Economic Projections, SEP. And you can see down at the bottom what they were looking for the funds rate. And the median was 4.6 from, they say 5.4, but the range is 5.25 to 5.5. So you basically 537. So that's where you got the 3 cuts. I think there's the potential that will tick higher to 475 and maybe 4.8, something like that. And so the market has been anticipating and ignoring the inflation data because, hey, we're going to get our cuts anyway. The other point I would make is when the FOMC members put this together in December, they were looking at a runway of 12 months. Now in March, the runway is shortened to 9 months. So if you thought, okay, maybe we'll be able to do 3 cuts, you weren't on the absolutely we're doing 3, maybe 4. You were like, okay, I think we can do 3. Now you got a 9-month runway. And given the recent data, I think somebody could, all it takes is probably 1 or 2 of these folks to dial back what they expected in December. And all of a sudden, these numbers shift. And I'm just not sure that the equity market is prepared for that shift.
Well, let's get into how the markets may react, because the first thing that we've seen, well, I was on holiday for a couple of days early on this week, but what I noticed is you had yields really rally, and so what would that do to Treasury yields here?
Yeah, well, I think they go higher. When we talked last Friday, I presented this idea of an A, B, C, D, E, type of a pattern, and noted that at 419, the 30-year had come down to that trend line and bounced. My expectation was that we were going to see Treasury yields continue to work their way higher. And, obviously that's played out. And if I'm right about, what the message will come from the Fed's meeting next Wednesday, that's just more negative news. And I think Treasury yields are going to push higher. So, again, the idea back in December was, and we've talked about this a lot, 1, 2, 3, 4, 5 down. Okay, so to me, that means, in my view, the longer-term trend in Treasury yields is down. But after a 5-wave move, you're going to get a retracement in the opposite direction. And, that implied that we were going to see a window of time where Treasury yields were going to be going up. I thought one of the impetuses would be we weren't getting 6 or 7 rate cuts. And as that would happen, Treasury yields would back up, and they have. I think, we're just going to see a little bit more of the same. Once this uptick is done, Blake, again, my outlook is that we'll see Treasury yields decline again. I think the economy is on the cusp of slowing by mid-year. And I think Treasury yields, the 30-year, I think, can get under 3.5. The 10-year, 330-ish, plus or minus. So I think there's another really nice rally coming in Treasury bonds with lower yields. But the pattern to me suggested we were going to see a period where rates were going to be going up. And I think, we're going to see that continue next week.
All right. Well, before we get into, you brought in a chart of semiconductors, and one thing I just want to mention to everybody is that that every week you come and you analyze the markets, you break down the macro backdrop, and if you guys and gals like what Jim does here, make sure you give him a thumbs up, subscribe to the channel down below so you don't miss any of this exclusive content. It is free to subscribe. It's also free to hit your bell icon so you're notified every time one of these interviews comes out. Matter of fact, last week it was running a day late. My fault. I'm going to take the blame. Totally my fault. But you would have known when it first came out if you were, you hit the bell icon. So make sure you do that, and make sure you jump in the comments down below if there's something that Jim says that warrants your attention.
Or ask a question.
Or
ask questions, and that's always great. I appreciate that, and I try to respond to everyone.
All right, and you brought something new for us this week. You wanted to share with us how you felt about the semiconductor index. So let's go ahead and talk about that, Jim.
Well, the reason we actually talked about this last week, Blake, because when we were talking, I said there's a potential for a key reversal in NVIDIA, the semis, and it followed through to the S&P. I mean, all the major averages basically had a key reversal last Friday, which is a higher high, lower low, lower close. And so to me, that's a negative. I could also count 5 waves up from the lows last October. At the same time, we can see every high has been higher, every low has been higher, and you can draw, the shorter term trend line is getting steeper and steeper in terms of rate of ascent. But until we take out that trend line, the uptrend is intact. Now,
No,
I think that trend line is going to get taken out, and wave
I was
four
gonna,
of lesser degree. Pardon.
I'm sorry. I was gonna say you also have some moving averages here. I'd like you to explain those because they look fairly. The SOX feels fairly compliant to those too. So
Yeah. Let's see. I think the green would be 13, and the blue is a 21-day expose,
okay,
and and the red is a 5 period. So, just one of the trend following tools is the red and the green. When the red's above the green, you got a positive trend. When it crosses below, you got a negative trend. And we can see, really going back multi months, the red has pretty much remained above the green line. And, if we have another few days of weaker, SMH prices, staying below the green line, well, obviously that's going to pull the red line down. So I think the equity market may not really be prepared next week for a message that is not going to be anywhere near as dovish as the markets perceived last December. Remember, everybody went nuts. Oh my God, it's a pivot, 180 degrees. Oh my God,
sure.
Powell's and I said, no, Powell never changed. And I think time has proven that that was absolutely correct. Wall Street was 100% wrong, looking for 6 or 7 cuts. I just think that's just going to continue next week, and that might be kind of the somebody rings a bell moment. Like, holy Moses, we may not even get the 3 cuts we were really talking about.
Right. All right. Well, let's you're obviously outlining the risk that the Fed might not, or the market might not be prepared for the for the Fed. Moving up the dots and anticipating less amount of rate cuts. So how's that going to factor into what the S&P is going to do, because the S&P continues to rally?
Yeah. I mean, again, it's the same story. You had a key reversal last Friday, but higher highs, higher lows, trends intact, and so you can see that the low this morning at 5108 is below the last low at 5,091, 5057. So to me, again, all these things suggest we're about to break down, but it hasn't broken down yet. So my expectation is that the S&P is going to close below 5,091, which was the prior low, and that'll be a greater confirmation that the uptrend of the last few months has ended. And again, when you take out trend lines like this, Blake, and you start taking out prior lows, especially if it's in a sense a gut reaction to news like, whoa, wait a second. I think the Fed news next week has the potential to do that. Taking out 5,057, I think, is even more significant because you had 2 lows right at 5,057, within a point of that level. So, again, my take is we're going to break down, but the breakdown hasn't happened yet. And that's, and what we've seen is the psychology and the momentum has been so impressive. I can make fun of some of the psychology, but at the same time, one has to respect it.
Sure.
But I do think that, that's going to change next week.
All right. Well, what's that going to do for gold? Because gold has been, obviously breaking out to all-time highs. Whoops, that's
This
the
is
dollar. I'm
dollar,
sorry.
by the way.
The dollar.
Yeah.
We'll go to gold next, but let's start
Yeah.
with the dollar, because you told us that yields are going to go up. So what's the dollar going to do as a result?
Well, this is kind of interesting because I think the longer term trend in the dollar is down. But the decline so far from 104.97 is 3 ways. If things play out as I'm laying out here, one would expect the dollar to get a tailwind, a bid. And if it gets above 104.30, it opens the potential, Blake, that the initial rally from 100.62 to the 104.97 was maybe wave A, 3 waves down for a B, and you're going to go out and take out 104.97. So 104.30, I think, is kind of important. My longer term view is unchanged. I think the dollar's trend in 2024 is going to be down, and I think the dollar will drop below 100 in the course of this year and potentially get down to 96. So now we're just talking about very near term. What are the squiggles going to be?
So are your C waves, so if we do break that 104.30, is your C wave typically an elongated wave, or is that your three wave is, your third wave is?
Well, one would think that it could be 4 points. You know, if it was A from 100.62 to 104.97, that's 430, yeah, 437. You're talking 106 to 106.50 to 107. Again, I'm skeptical of that. At the same time, I would not want to be short the dollar if it gets above 104.30 until we get, something that says, okay, now we're ready to go down. Okay. My initial expectation, Blake, was the dollar was going to bounce. I thought it would not overlap 103.43. That's the low of wave one. Wave four is not supposed to overlap. Okay. So it has done it by a small amount. But again, my initial thought was we were going to get 5 down from 104.97 and then get a bigger bounce.
It's interesting, and I don't want to use this analogy, but I'm going to anyway because I think I have to. I loved when I go to Las Vegas. It's a couple hours away, and I do it more to have fun versus making money. And I love to play blackjack because I play blackjack by the rules. It's like, oh, I have a 17, don't hit, and if I have a 16, I'll hit, and it's like, I follow the rules, and you follow the rules in your Elliott wave counts in a very similar fashion. Like, it shouldn't do this, but if it does this, then you have to respect it. You may not like it, but you have to respect it. And that's
right. I mean, right? We're driving a car on a road that doesn't have GPS. You know what I mean? And there's no map. Okay. Right. So we're driving down a road and, all of a sudden curves show up. Well, what do? Just keep driving straight and you're in a bush. Right. So, I like that analogy because it really means that when we drive a car on an unknown road, you just keep your eyes on the 100 feet in front of the grill. Yep. And you just try to do your best to stay on the road. And Elliott wave, I use this, people, I've gotten, some people have kind of criticized Elliott wave, and I get it. My view is Elliott wave is helpful 1/3 of the time. 1/3 of the time, you're going to have 2 or 3 choices. Okay, well, it's kind of helpful. 1/3 of the time, it's worthless. So to me, it's just like every other tool that we all use, momentum tools, trend following rules. They all have some efficacy, but they're not infallible or perfect. And so, you have to, I try to keep that in mind, that all I'm trying to do is hedge the bets and be able to make an intelligent guess, but not forget the word is guess.
Yeah. And I think that's a great way to put it. All right. Well, look, the last thing that everybody wants to see gold. What's that mean for gold here? Because gold has broken out. We're still maintaining the breakout. Yep. We're near all-time highs. Is this going to
continue, Jim? Well, given the bounce the dollar's had, I think the modest pullback in gold so far is pretty impressive. My take is that the high at 21.93 was wave 3 off the low at 1986. My expectation is, Blake, we'll see another push that gets marginally above 21.93 to complete 5 up. And once that happens, then I think there will be a deeper pullback in gold before the next significant rally takes place. Again, I think 2,300 or higher is coming this year. But just like we said a minute ago, we're trying to navigate the road. What the road suggests to me is that gold has a pop, and then it completes 5 up. Then you're going to get a retracement of that move. What is it, $200 plus move?
Yeah. I mean, nothing happens in a straight line in the markets. We wish they did, but it's not the way things work. So, Jim,
Yeah.
I appreciate you guiding us through every week, and if you guys at home do as well. But what's the best way for us to get a hold of some of your work to try it out?
Macrotides.com, or send me an email, jimwelshmacro@gmail, and I'll send you a recent copy of a letter.
Great. And remember, folks, if you send Jim an email, tell him you listen to him at the Traders Summit, and he'll give you a nice generous discount too.
Yep, absolutely.
All right, Jim. It's great catching up with you. Even though I was absent for half of the week, it's great to get caught up with you. And I know everybody looks forward to Fridays. So for all sorts of reasons, but Jim,
Yes,
being
and
here,
I say many of them are way more than just seeing our mugs, but
Yeah.
that's okay as long as
Yeah.
they do see our mugs.
That's right. Right. All right, Jim.
All right,
Well, I'll
take
look
care.
forward to catching up with you next week. Thank you so much for being with us today.
You're welcome. Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.